everyone. So before we get into today's video, I want to show you something. Let me draw some lines and perhaps show you some magic. No, it's not a magic show, rather something magical. So here we go. What I have in front of me is the 1 year, 1 day chart of the stock CRISP. I am going to take the latest bull run bottom, put my starting point of the graph there, and I'm going to put my end point to the latest high. Notice now something magical. The other lines in this drawing magically intersect with the other local resistances. It's as if this stock was always planning to reach this point all the time it has been trading. What if you knew what the stock was planning to do before it occurred? Do you think it has really powerful information to place your trades at the right moment? Hi, this is Purti, and in this video, let's talk about the Fibonacci retracement. So, what is Fibonacci retracement? In a nutshell, these are support and resistance levels based on ratios created with the numbers in the Fibonacci sequence. If you remember from your school math 101, Fibonacci sequence is calculated by starting with 0 and 1 and then adding each number in the sequence to the previous number to get the next number. That is 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, 5 plus 3 is 8, and so on. So the sequence is 0, 1, 1, 2, 3, 5, 8, etc. But what is the significance of the Fibonacci sequence? Have you ever heard of the golden ratio? It is a unique ratio that can be used to describe the proportions of everything from nature's smallest building blocks such as atoms to the most advanced patterns in the universe like the unimaginably large celestial bodies. Nature relies on this innate proportion to maintain balance, but the financial markets also seem to conform to this golden ratio. The ratio is derived from the Fibonacci sequence we just discussed, named after its Italian founder Leonardo Fibonacci. But this sequence is not all that important, rather the essential part is the quotient of the adjacent number that possesses an amazing proportion, roughly 1.618, or its inverse, that is 0.618. Take honeybees for example. If you divide the female bees by the male bees in any given hive, you will get 1.618. Try measuring your shoulder to your fingertips and then divide this number by the length from your elbow to your fingertips. Or try measuring from your head to your feet and divide that by the length of your belly button to your feet. Are the results the same? Somewhere in the area of 1.618. The golden ratio is seemingly unavoidable. Here's how it works. Take any two adjacent numbers in the sequence and divide the lower number by the higher number. For example, 5 divided by 8 is 0.625, 8 divided by 13 is 0.615, and 13 divided by 21 is 0.619. Notice that they are all very close to 62%. If you keep going like this, the numbers continue to approach 61.8, which is the number accepted as the average of this ratio. So keep this 61.8% in mind. We'll come back to it later. Next, take a number in the sequence and divide it by the number which is 2 further along in the sequence. This equation gives you a number close to and approaching 38.2%. For example, 55 divided by 144 is 0.38. So you can do this with any of the numbers in the sequence and you'll roughly get 38.2%. If you keep going by dividing the number which is 3 further along in the sequence, you get 23.6%. So far we have 61.8, 38.2 and 23.6%. Those are all the Fibonacci ratios used for the retracement in the financial market. What are the benefits of using Fibonacci retracement? The greatest benefit of the retracement might be understanding the concept of the self-fulfilling prophecy. One of the things you want to understand as a trader is human psychology. When it comes to using indicators like Fibonacci retracements, psychology comes into play. If enough traders use that retracement indicator, then you can potentially predict buy or sell opportunities. And if enough traders act when price action reaches those levels, then it actually becomes a self-fulfilling prophecy. Some traders use Fibonacci trading to determine automated stop losses, but be wary, however, there are dozens of possible indicators out there. Not every trader uses Fibonacci levels, but it pays to be aware of what other traders might be thinking. How to use Fibonacci retracement in technical analysis? Let's take an example of Etsy. I'm using the 5-year one-day chart. Notice in the top right, I'm using the percentage symbol in the drawings to draw the Fibonacci lines. First, you start by placing the tool at the lowest price at $27.48. This is the 0%. And you drag the tool to the highest price, that is $251.86, which is the 100%. You can use this for even short-term time frames like the 1 day, 1 minute chart as well. If you notice, the price has been rising through March and April 2020, and at around May 2020, it has found resistance at 78.6%, which is $74.8. Again, the price rose till it found resistance at 61.8%, that is 111.94%. Again, the same thing continues and the price touches 50% mark and drops back down. Around September 2020, it has found support at 61.8%, that is again $111.94, and the pattern continues. And if you notice, not every retracement follows the Fibonacci levels. Also, the lines and prices may not exactly coincide, but it's an approximate figure to establish support and resistance levels. You can use these support levels to place your long positions and the resistance levels to place your short positions, or to get out of your long positions to take profits. If you reach the support level and you want to know how much further along your stock will move, you can simply extend the Fibonacci lines so that the high coincides with the 23.6% and the line where the 0% stops would be the price that the stock may run up to. In this example, the stock currently is at $221.14, so you can get into the long positions at this price. It is consolidating and seems to have found support at this price, so the stock would go up. If the stock goes up, it would run up until $251.86, not considering other catalysts. It might find resistance at this price, and if and when it breaks this level, the next price that the stock might run up to is $319.8. Always look for a confirmation signal before placing your trades. One way to be sure is to invest only when supports and resistances of these patterns are broken. That is, look for confirmation of patterns. Look for a green candlestick with a good volume to confirm your stock price rise from a resistance level, and look for a red candlestick with a good volume for a price decline from a resistance level. Barring any other catalyst, there's a good chance all the stocks follow these patterns, as these patterns are backtested. So here are a few points to consider when using the Fibonacci extensions. First, never use it as a standalone indicator. Always use it in conjunction with other indicators like moving averages. Second, Fibonacci are never 100% correct. They are general indicators stating if market conditions are normal, that is, barring any new catalyst for the stock, these trends will hold true. Third, typical Fibonacci retracements are 38% and 50%. Fourth, Fibonacci's should only be considered as a probable projection in the stock run or fall. Fifth, Fibonacci's are trend secular, meaning that they work well in the latest uptrend and downtrend, but not over a graph of multiple uptrends and downtrends. And sixth, lastly, the Fibonacci's work best in the boring market conditions and never in the volatile market conditions. So that's a wrap on this video on Fibonacci retracements. Let me know what you think of this video and post your questions in the comments below. And keep in mind that this video is for information purposes only and should not be interpreted as any financial advice. If you like this video, don't forget to like, share and subscribe, and hit the bell icon for more videos on financial literacy. Thanks for joining me today, and I'll see you all in my next video. Bye-bye.